Hey guys, it's Dave. Welcome back to the channel. This video is extremely long overdue. I'm going to take a deeper look at the valuation of Planet Labs, look at some of the projections where their revenue is going to be over the next 5 years, and try to make a model, a basic model of what it could be worth depending on, what sort of scenarios play out in the next couple years. If you're not too familiar with Planet Labs, this is my second investment in the space industry behind Rocket Lab, and they play in the Earth observation space. Their big claim to fame is really taking an image of the entire globe pretty much every day so you can see how change is happening in real time day by day and get a better idea of the trends. Very interesting company. They've been around for quite a while, and I'm really just taking a deeper dive here to see if I think it makes sense to continue buying more shares. Now that Rocket Lab has gone up in value quite considerably over the last few months, I still love the company, but I don't think I'm going to be adding any more shares right now. It doesn't seem like the right time to me. That being said, Planet Labs has not participated in the latest run. They had a disappointing outlook in their last earnings call, and the stock has really been massively punished since then. So it could potentially be on the cheaper side, at least right now. Let's take a look at it and see if I think I should add some more shares. Before we get into that, though, I hope you'll consider hitting like and subscribe by the end of the video, and I'll check out your comments down below. With that out of the way, let's dive into Planet Labs valuation. I just wanted to show one thing to you really quickly that I thought was interesting. First of all, the market cap of Planet Labs now sitting under $1 billion. We're at 921 million as of when Yahoo Finance was last updated. Usually they're pretty up to date. But the interesting thing I thought here is if you look at their total cash balance, we're at almost $400 million, or they are at almost $400 million in just cash sitting in the bank. So really, right now at least, the entire value of the whole company, which has one of the largest satellite constellations for Earth observation in orbit today, all that value, if you subtract just the cash in the balance sheet, is being valued at, 600 million or less. So I just thought that was interesting because the balance sheet is quite strong compared to a lot of these other space companies. And when you really take out just money they have sitting in the bank, I find it quite illuminating. But with that out of the way, let's take a look at some spreadsheets, and we'll dive into some projections on their revenues for the future. Now, first of all, where am I getting my information from? Well, we had a lot of updates on their most recent earnings call that provided some guidance for the future, and I'm taking the information straight from that, so I'm not just pulling numbers out of thin air. I've got some quotes for you from that earnings call just to show you where we're drawing from for these projections. So in their update, they said that for fiscal year 2024, because they're on a different schedule for fiscal year than the actual year, which I always find super annoying, their fiscal year of 2024 actually ends on January 31st, 2024. Figure that one out. Planet expects revenue to be in the range of 225 to 235 million, representing only 20% year-over-year growth, kind of at the middle of that range. It compares to previous forecasts for higher revenue growth, so they're basically pulling back on how much revenue growth they do expect. They're also saying that their non-GAAP gross margin is expected to be around 52 to 54%, and adjusted EBITDA loss is 67 million and 58 million in between those numbers. So we're keeping those numbers in mind when we go to the next screen in terms of building out our financial model. Just some color on this. They did say that sales bookings came in lighter than expected, and they observed a combination of factors coming together, including extended sales cycles, blah, blah, blah. I mean, yeah, sales were weaker than expected, basically. They're revising their guidance, presuming that these trends are going to continue for the rest of the year. And they are still trying to maintain their target profitability date, which means that in order to do that, they're going to cut back on their expenses significantly because they're expecting to make less money. So to make up for that, they're going to spend less. Of course, the potential downside to that is if you're spending that money, the plan is obviously that money to be spent on future growth. So lower investments could mean lower returns in the future. They're estimating that these changes will reduce their annual run rate expense by more than $35 million going into the next fiscal year. That's going to be important too. And yeah, I just thought it was interesting. One of the big declines in their gross margin is because two of their satellites are re-entering Earth's orbit or atmosphere earlier than expected due to some solar activity, which was unusual. Thought it quite interesting how this solar activity can impact satellites. But yeah, so two satellites re-entering Earth's atmosphere earlier than expected, costing them some money, hitting their margins. So that's kind of some of the information we're working off of in terms of what was shared in this most recent earnings call. But I'm also drawing from what they originally told us back when they went public a few years ago. So when all these SPACs did have their go public presentation, they would share projections of what they thought they would do. And this is what Planet Labs said they would make and what they would do financially. So before the SPAC, so this is obviously set in stone, they were growing at a 27% compound annual growth rate year over year. So every year revenues were increasing 27%. Pretty solid, not, shockingly good or like outstanding, anything like that. I would consider those to be just pretty solid numbers in terms of growth year over year. But when they were going public, they said they expected that to increase to 44% year over year compound annual growth rate, which I do consider to be extremely good. Anytime you're starting to get to like the 40s and 50% range, I do consider that to be quite good. And they're also sharing how much of that they think would be gross profits. And do remember, gross is very different than net and doesn't include things like administration and research and development. So that information is also informing our next page, and we also wanted to check the margins of how they were doing. So they projected gross margins for 2021 and 2022 of 40% and 50%. They came in slightly lower than that now that we, have had these years as them being a public company. They came in at 36 and 49%, but very close. So this does give me some confidence that they're pretty close to their estimates. And in terms of revenue projections, they're pretty much exactly right on. They hit these numbers pretty much exact in terms of revenue. So I do have some confidence that they can hit their guidance and that they are accurate, unlike some other companies where I've seen they've been way off on their guidance. Now, going into the bull valuations, what I'm assuming for the future for this bull valuation is that they're growing by that 44% mark for the next several years, minus this 1 year, which is going to be about 20%. So we have a 1 year slowdown that they shared that in the last earnings call. They expect a 20% growth or something like that, and then continuing on back at that 44% rate until 5 years out or so, 2028. If you watch my other videos, I always like to shoot at least 5 years out into the future, give you more time than just 1 year. 1 year projections I don't tend to put a lot of stock in. So obviously that's just income, but then you're looking at gross margins. And again, we're going with what they said back in the original projections. They told us how much they expected their gross margins to go. So the bull valuation is just saying that they are right on and those gross margins are accurate, basically maxing out at around 74%, which is very good in my opinion. Cost of goods sold, this is just like how much it costs them to make those sales. Cost of goods sold is basically just the inverse of your gross margins, because if you made 53% on that, then 47% was what it cost you to, provide that service. So we're talking about a 47% cost of goods sold, or $108 million for 2023. And then just going by what they said yet again, so 38%, and then continuing on. We can see that 2027 is when the numbers start to get really interesting. We're talking like $1 billion almost in revenue. So that's when things start to get quite exciting. Operating expenses. Now this line item includes things like selling, general, and administration, as well as research and development, that kind of thing, but I just combine it all into one for simplicity's sake. Now, since they said previously, if you'll recall, they're going to be cutting costs by about 35 million, I do actually have this column dropping by about 35 million for the next year, and then continuing on with very slight increases before, more regular increases. So I have the cost savings continuing on for a couple years before they start, growing their operating expenses by 15%, that compounding going forward. That seems like a pretty reasonable number to me. Then you subtract all this out from the revenue, of course, and then we're going to get how much money they're really making. So 2023, we're looking at negative 112 million. 2024, down to negative 34 million. This is EBITDA, by the way, not net income. Before turning EBITDA positive in 2025, then 2026, 2027 is when we get really EBITDA positive. So the interesting thing here is that they've said they plan to be EBITDA positive by the end of 2024. Maybe that's an EBITDA positive run rate going forward, because for the year 2024, at least, I'm not seeing them getting EBITDA positive based on the numbers they've provided, whether including, gross margins, revenues, all those numbers they've provided. To me, that's not EBITDA positive at the end of the year. So they must mean like that Q4 will hit a run rate of being positive, or they'll be at the point of turning positive after that. So after 2024 is when they start making significant amounts of money. We're at 15 million, 150 million, 300 million. This is when things start to get pretty good for the company. And again, this is pretty much the bullish case, them hitting all their projections. So now that we know how much money they're going to either burn or make each year, we multiply that by the outstanding share count and the price to earnings multiple to get the total market cap of the company. So you can see I also did increase the outstanding shares, as it's pretty common for, this should be a 2, by the way, sorry about that. I gradually increased the outstanding shares, as it's very common for compensation and stuff like that, or shares to increase, although I did check, and they're pretty minimal increases in share count right now, at least for the company, which is really good, by the way. If you see the share count rising a lot, that's generally less of a good sign. So I do have pretty modest increases in outstanding shares year over year until we get to 2027 and 2028, which is the 5-year out target when I'm really building my model to work towards. Okay, so now going through all that, I hope you guys are still with me. We have the amount of money they're going to make. We have the number of shares roughly we think they're going to have, therefore how much they're earning per share. And now we need to decide on what price to earnings multiple we think they will have at this point in time. Now we do need to decide on the price to earnings multiple we think will be fair for this company going forward. They do play in the Earth observation space, so I was trying to find out some comparables. Very difficult though, because a lot of their competitors like a Black Sky or Aspire who play in the same space are also not profitable yet. It's really a new growing industry, so there's not a lot of real comparables to check what price to earnings ratio seems to be fair. However, I did look at Maxar. They're being purchased, but historically they have had a price to earnings anywhere from in the teens to like 30 plus. So I just threw in an average of maybe 22, 25 here. Although do keep in mind Maxar is more of a stable name. They pay a dividend. They're not a big growth name, and usually higher growth names do get those higher multiples, the premium multiples. So perhaps just Maxar is not a perfect comparison, because if these numbers were accurate, Planet Labs would be growing much faster than Maxar was. And then another name in this space, although they do a lot of other spaces as well, it's a big company, is Airbus. They have quite a fluctuating price to earnings multiple. I've seen it anywhere from 13 to 47 over the past few years. So call it maybe 28, 25, 30-ish seems fair. Those are kind of some comparables I looked at. So with those comparables, I picked a price to earnings of 28 just as a benchmark, but we can always play around with different numbers if we think it'll be higher or lower. So In each of these models, we have a discount rate, or WACC, some people call it, which is basically saying the time value of money, and you include different factors into this, like the amount of risk you're taking on, how much your money is worth for that time, as well as the industry. Different industries tend to have different WACCs or discount rates. So I'm putting in a discount rate of 15% per year. That means for every year you own the company, or every year that goes by, the value of the cash would be worth 15% more. So you bring it back each year, reducing the value by 0.15 per year as well. We come out to, as you can see, times 0.85 for each year that we are waiting until 2028, means that the present value should be more like $19 a share if you truly, truly believe they'll be making this $520 million in net income in 2028. And then in 2028, if they did make that net income number of 520 million, they would have a value of $50 per share. So, I mean, the company right now is sitting at in the threes. So going to $50 per share in 5 years is clearly like massive exponential growth. But you may think, this is a riskier play. So perhaps you want to increase this discount rate higher, more like 20 per year. And then you have this number come down to something a little lower. Maybe you think there's less risk and you can even reduce this number. The other thing we can do is maybe we think 28 is too high of a price to earnings. You want to see what happens if it's just like, say, a 20. Well, if we change that to 20, that means the present value today would be more like a 13 in our bull case, and the terminal value 5 years from now, 2028, is more like a 35, which is still a 10x. Like, this is kind of insane numbers, really. Of course, it all is predicated on them hitting these revenue numbers, and who knows, maybe at that point in the future, they're investing aggressively for even more growth, so they're not banking all this in profits. They're putting a lot more into R&D, which could compress those numbers. It's all, what ifs, what will happen. But this is really the bull case scenario, the best case. They do get profitable near when they say they will. They do start making a ton of money by 2028. And this 1 year slowdown in the compound annual growth rate is really just a bump in the road. But we do want to take a bear case valuation here to kind of say, well, what if they're wrong? What if what they're saying doesn't pan out? And see where we lie there, because you really want to take like a best case scenario, worst case scenario, and what you think is a most likely scenario. So this is a bearish scenario, probably not worst ever case, but kind of like a rough case. Basically what I'm saying here is that instead of having 1 year of 20% growth rate, like a bump in the road, and then going back to 44% growth per year, we're going back to what they were doing before they went public. So only about 27% per year growth, as opposed to this massive 44% per year number. Still pretty reasonable growth rate. Maybe they don't get back up to that 40% compound annual growth rate number. This is more of a bearish case. So we're looking at 292 million, multiplying it by 1.27 every year, going to 2028. Sorry, I just realized I'm probably covering some of this. The revenue for 2028, at this point, we're looking at only $750 million, not getting into, the billions, but still pretty decent revenue numbers. However, their net income only in the positive at this point by about 100 million. And do keep in mind that I'm actually in this a little bit more bearish case scenario. I'm keeping their margins at the top the same. So even a worst case scenario would be these margins get even worse, in which case the numbers get even worse. This is more perhaps based than a bear case because their margins do stay strong here. So same calculations with the same net income in 2028. Means that their future price to earnings multiple still a 28 per share. Again, you can always play around with that yourself. We're looking at a terminal value in 2028 of only $10 per share, meaning that the value today, taking into account the time value of money and the risk, is about $4 per share. So a little undervalued today, even in this case, but not like the massive undervalue that we saw in that bull valuation. When I am looking at a company, I do like to see that even a more bearish scenario is undervalued and maybe not the end of the world. Now, if you want to go even more negative, maybe they're only commanding a 20 price to earnings rate in 5 years, as well as making less income. Now we're looking at $3 per share, which is kind of around where we're sitting right now. That's more fair value. So it all has to do with how much money you expect they're going to make in the future, what their margins will be, how fast they'll be growing, all those sorts of things. And everyone can really just put in their own assumptions in these boxes depending on what you think. So one other thing I do want to check when I'm doing these valuations is making sure the company has enough cash to get to profitability in both these different scenarios. The first scenario, that's more of the bearish side of things. You can see they're sitting at like, call it 300 million right now. Last reported quarter was more like 370, but today they've probably spent more than that. What we can see is that they keep spending until they hit profitability. More like 2026-ish is when we hit the bottom. At this point, they still do have $130 million in the bank before they start making money. So in this bearish case scenario, still not going out of business, which is a big plus for me. I do look at some companies and then I look at a bear case scenario and they have nowhere near enough cash to get through to profitability. And then obviously this bull case scenario, perhaps not the most realistic, because if they were printing this kind of money in the future, they'd probably invest it in other things perhaps. But the cash balance really bottoms out at more like $250 million. And they just go up from there, like way up after hitting profitability. So those are the financial models I came out with on Planet Labs. As for which of the two you think is most likely, I'll leave that to you. Obviously, all these assumptions are subject to change. Am I going to buy more Planet Labs? I just might. I'm still thinking about it. It does seem like a little cheaper at this point than Rocket Lab, even though I do love Rocket Lab, of course, and I have a much larger position in Rocket Lab. Planet Labs, my position, still fairly small, and going by this model, I may add some more. I think we're looking at fair value today should be at least a little higher than what we're seeing in the threes. So far, though, this management team has pretty much hit most of their projections, with the exception of this current year where they've had the pullback. So mostly I do trust them. That is it for today's video, guys. I might share this spreadsheet in the Discord server in case anyone wants to hop into it and put in their own numbers and see what the valuation comes out as. Link to the Discord server is down in the description below. Thank you so much for watching. If you haven't already, I hope you'll consider hitting that subscribe button, and I will see you guys in the next video. Bye for now.